In this episode, we're going to look at how banks typically offer credit facilities to tech companies and explore some of the differences between how non-bank lenders approach the market. Firstly, let's look at the instrument used. The Accounts Receivable, or AR facility, has been around since the 1980s and remains largely unchanged since then. It involves looking at all of the company's AR at one point in time and a line of credit to borrow money against the value of these invoices. Invoices are typically submitted on the last day of each month, verified manually according to the bank's underwriting procedures, and then can be drawn down as required. The loans are repaid as the invoices are paid down, so the process is known as revolving credit. While this approach has served many companies well in the offline space, in the fast-moving app economy, many founders have complained that the product itself is clunky and generic and is not the best fit for their needs, opting to go with a lender who has a built-in product specifically for their vertical. Let's go back and have a look at how bank AR facilities work and compare them against how a revolving credit facility from a non-bank lender works. First of all, advance rate. Most banks will lend up to 80% of verified invoices. Depending on the bank, there will be further exclusions, typically non-domestic invoices and larger transactions that would exceed concentration limits. Contrast this with a facility from a lender like Pollen VC, who lends not just against AR, but also the value trapped in your existing users. So the amount of credit extended could easily be 200 to 300% of your AR or even higher. Next up, verification. Here, there is a real difference. With most banks, they look for evidence of the AR through invoices, screenshots of platform portals, etc. to verify the AR is genuine. There's also usually one snapshot submission window per month, normally the last day of the month when everything must be submitted. Non-bank lenders like Pollen VC use technology to streamline this process, pulling the data each day from all of the relevant platforms, such as app stores and ad networks, to verify the AR digitally. This approach has the added benefit of not having to wait until the very end of each month. The delay of having to wait until the end of the month to submit to a bank can cost real money to the company and opportunity cost of not being able to reinvest back into UA. So it's definitely something to keep in mind. Fees is the next thing we'll explore. While a bank may offer a lower cost of capital and a headline rate, these facilities are typically loaded up with a cocktail of fees that increase the overall costs. You'll see setup fees, administration fees, collateral handling fees, and minimum charges that non-bank lenders typically don't charge. Warrants. On top of fees and interest, banks will normally look for equity warrants in your business as well. Although typically small in size, these can add up over time, so if you value your equity, then factor this into your equation. There are other factors that can make it a better choice to work with a non-bank lender. For example, many banks will only lend to VC-backed companies and insist on you having your main banking relationship with them. So in a way, banks are penalizing capital-efficient founders who have bootstrapped their businesses to success. So in summary, banks may offer a cheaper headline rate than non-bank lenders like Pollen VC, but there are some drawbacks too. So it's important to find the best fit product for your own business. If you have a traditional AR facility with a bank or are considering putting one in place, you may want to check out our Bank Fee Debunker. This calculator allows you to unpack all the different fees charged by the bank and show you the true cost of funding across all levels of utilization of the facility. Head on over to pollen.vc and click on our CFO Resources tab to check it out.